I'm David from Kepler Trust Intelligence. Today I'm joined by Matt Cable, Fund Manager of Rights and Issues Investment Trust, which has the ticker RIII. Matt is here to talk to us about his portfolio and the outlook for UK smaller companies. So Matt, thanks for joining me today. Now Rights and Issues runs a relatively concentrated portfolio. I just wanted to kind of get your views on why that is and why you feel it's a good approach for kind of investing in UK smaller companies and what advantages it confers to shareholders.
Yeah, that's right. So I'm not sure it's necessarily just a smaller companies thing, but you're right. We run the portfolio with about 20 to 25 stocks, so quite concentrated. And of course, the benefit of that is that you get a real distillation of the investment process. So it really focuses on what we're trying to do with the fund. And obviously, the cost of that is that you typically will see more volatility with a highly concentrated portfolio. But of course, the benefit of having a closed-ended structure is that we can cope with that volatility, particularly in that sort of smaller end of the market, where you'll see a little bit more movement in the short term. So we really like it. We run it as part of a suite of funds as a team on our desk, which will range from much less concentrated open-ended funds through to Rights and Issues, which is the most sort of distilled version of our process.
Yeah, that's really interesting. Now, active management has been much maligned for a long time now, but there are kind of advantages in certain parts of the market, we'd say, and UK small caps is kind of one of those. Why do you think this is, and kind of how can yourself and active managers in general kind of add value over and above any index fund that kind of tracks whether it's mid cap or small caps?
Yeah, no, it's a good question. And of course, if you look across the market generally, active management has had a tough time as passive has encroached. The simple answer in small cap is that it's actually very difficult to do it on a passive basis. So actually, because the liquidity is often quite limited, it means that putting together a true passive portfolio is quite difficult. And that's why you don't see many products like that. And the ones that you do see often track benchmarks, which we wouldn't really see as being small companies. The other reason, though, perhaps more fundamentally, is that if you look at the distribution of returns for smaller companies compared to larger peers, what you see is a much wider distribution. In other words, lots more winners, lots more losers. And there are lots of reasons that the academics would point to for that: lack of research, low liquidity, and greater sort of rates of change in the companies. But what, of course, it does mean is that an active manager, there's the opportunity to outperform by making sure you pick the winners, avoid the losers in general. And so there is actually scope to outperform over time. So I think there's both a sort of a practical reason and a sort of a theoretical reason why active management works for small companies.
Yeah, I think that's a really good point, especially that kind of lack of smaller company index funds. We think that investors really need exposure to smaller companies, especially in the UK. So hopefully, active managers like yourself are kind of providing a good service. Moving on to the backdrop for smaller companies, UK smaller companies in particular. Clearly, it's been a challenging period in share price terms, despite many of these companies performing well operationally, actually. How do you kind of assess the current backdrop? And I guess the million-dollar question is kind of, what is the catalyst that can kind of help to unlock the value that we and yourself see in the area?
Yeah, as you say, very much the million-dollar question, and one that we've been scratching our heads over for a long time. I mean, I think there are longer-term and shorter-term factors at play here. And as lots of people will be aware, one of the long-term challenges is that you've seen this de-equitization and persistent outflows from UK funds in general, and particularly the smaller end. And I think you can trace that all the way back to changes in the pension market and the transition of defined benefit schemes to more mature funding situations, which means that they've de-equitized and moved into sort of more bond-based investing. And at the same time, you've seen this very persistent trend to more global investing and away from that sort of that home bias of investing in UK equity. So I think if you go back 20, 30 years, you'd have seen perhaps 40, 50% allocations by UK defined benefit schemes to UK equities. That's now, I think, around 3%, which is actually below the global weight for UK equities. And that persistency of outflow, of course, just inevitably has an impact on valuation. So I think we've seen that going on in the long term. I think in the shorter term, one thing that I find interesting is if you look at the valuation to the price earnings ratio of the FTSE 250 in about 2015, it was about the same as the US market. And what you've seen almost every year since is this sort of widening gap as the US has continued to perform really well. In the UK, particularly those more domestic stocks, it's been really difficult. And look, without getting into a big debate about Brexit and the specifics of that policy, I think that there is this perception that the UK has struggled from a governance perspective, and that has put people off investing here. And often investors will conflate the UK market, which is actually quite an international stock market, with the UK economy. So you've got this sort of the short-term negativity towards the UK. So what changes? Well, I think in the longer term, sort of weirdly, that persistence of outflow is now becoming a good thing because it just can't keep going forever. So that divestment, particularly by pension funds, must be coming to an end because the allocations are so low. So that fundamental headwind starts to go away. And then I think the real question is just around what it will take for investors to see the UK in a more positive light. And of course, that's a real challenge because if it were obvious what that was going to be, then I think you'd have seen the change already. I mean, clearly, as we speak, we're looking at yet another change of Prime Minister. Maybe this will be the one where we actually see some different policy making, perhaps a more politically astute character who can make some of the sort of more difficult decisions that will actually get the UK growing again. And one of the things that's, and it's grasping at silver linings, but that has been a positive in the last couple of years is that government have at least been taking this issue more seriously. So we have started to see reforms, things like ISA reform, that show that the government does want people to put money into productive UK assets. So who knows exactly what the timing will be, but it does feel to me like once that catalyst arrives, we could see quite a dramatic re-rating in the UK because it has been so difficult for so long.
Yeah, absolutely. And moving on to the portfolio again, and looking at kind of positioning, where are you kind of positioned at the moment, and are you kind of seeing any interesting, attractive opportunities around?
Yeah, so again, coming back to the concentrated nature of the portfolio, it's quite a low turnover approach. So we don't tend to position it in the way that some people would mean, in the sense of trying to reflect macro views. So we don't do that. It has, if you like, a sort of fairly stable structural positioning, which is simply put a tilt towards quality and value. So our process is very much around identifying good companies with good growth prospects that are available at attractive valuations. Inevitably, what that means is that as you put that together into a portfolio, the portfolio analytics will show you a tilt towards quality, a tilt towards value. Just by dint of history, the fund has had a bit of a tilt towards industrials, and again, that fits quite well with that investment approach. So that still exists. It's not as extreme as it would have been a few years ago when we as Jupiter first took on management of the portfolio, but it's still there. So if you like, it's a tilt towards relatively straightforward, high quality companies where we see significant value.
Yeah, and you talked about those quality characteristics that the portfolio demonstrates. I wonder if you could just kind of touch on a few of the things that you look for in new investments. What are you looking for in a company?
Yeah, so I mean, a lot of the classic quality characteristics that we look for are ones that people will be familiar with. So things like high returns, solid cash generation, strong margins. But of course, what we're also trying to do is identify the factors behind that. And some of those will be objective things like strong brands, high quality products, well invested assets, but also the softer things like culture and management. And a lot of that you can only really do by just spending lots of time with the companies, with management teams, do lots of site visits, lots of sort of customer referencing, those kind of things, to really understand the factors that sit behind the quality metrics that we also care about. So it's trying to put the two together.
Yeah, and can you share an example of maybe a holding that's done well recently, and just kind of talk us through what kind of attracted you to that particular stock?
Yeah. So one that comes to mind would be Ashtead Technology. And very classic situation. It's a company that we've known a long time, since its IPO. We've held it on some of the open-ended funds in smaller size for some time. And just to give you the context, it's a marine services company, headquartered in Aberdeen, and it operates effectively a rental model. So most of the work they do will have some sort of piece of kit associated with it, and that could be anything from a remotely operated submarine through to 800-ton linear winches that go on the side of oil rigs and so on. And it's got sort of quite a classic setup for us, in the sense that it's when a lot of people look at it, they'll say, well, it's a rental business. What do we compare that to? We'll look at other rental businesses in the UK, which of course typically are fairly generic sort of cost of capital type businesses. The difference with Ashtead is that essentially everything they do comes with a very high service element. And so when you look at the returns it generates, it doesn't look anything like a rental business. It actually looks quite asset light. And so you can see there the sort of the seed of an idea. And the interesting thing with this one is that actually it did quite well after its IPO. And then as we sort of got to about a year ago, they got caught up somewhat in the whole tariff debacle. And so the shares derated a long way. People started to worry about the oil price, which I think is a real red herring for them. Long story short, shares got very cheap. And the question for us is this something fundamentally changing about the business, that initial thesis around quality, or is this just market noise? And having sort of done the due diligence, I had a trip to Aberdeen to go and take a look at it all. We got comfortable that it was very much market noise, added the position to rights and issues, which obviously is a degree of commitment given the concentrated nature of the portfolio that isn't necessarily there in the open-ended funds. We're prepared to be very patient, and actually what's been really reassuring, partly catalysed in fairness by what's happened in the Middle East, is that has worked quite quickly. So the shares have been a really strong contributor to performance, to the trust's performance this year, effectively as the market has got over that short-term noise and has started to refocus again on the fundamentals of the company.
Sure, and we had the AGM of Rights and Issues earlier this year. I just wondered whether there were any kind of key outcomes or messages that you kind of wanted to convey to shareholders or potential investors.
Yeah, absolutely. So this was an important year for the AGM, and that really goes back to the previous year. The context for this is that for many years, long before Jupiter's time, Rights and Issues has operated a share buyback as a discount control mechanism, has bought back up to £1 million worth of shares every month, and that's been very effective. But last year, one of our largest shareholders decided not to support an ongoing authority for share buyback, and so by a very, very narrow margin, that came to an end. And what you'll see if you look at the chart is that inevitably meant the discount blew out, and see not a great result for the vast majority of shareholders. So going into the event this year, there was a concerted effort to reach out to more of our shareholders, encourage them to vote. I'm obviously really pleased that the buyback authority was re-established this year. So the board are able to again to buy back shares. Now, it hasn't reclosed that gap in the discount, but my view, and I'm a shareholder myself, is that actually I don't really care, because either eventually the discount will close up, which would be a great result, or of course we get the NAV accretion, so buying our own shares cheaply just means the NAV mechanically goes up for ongoing shareholders. So whichever of those outcomes we get will be good news for shareholders. So that's a really good piece of news this year.
And looking ahead, how optimistic are you about the kind of opportunities that you see and hope to see in kind of UK smaller companies?
Yeah, so I mean, look, the UK macro setup, as we said earlier, is I feel like at some point something will change. Long term optimistic, short term really hard to call. So absolutely don't sit here and say my crystal ball is telling me that UK politics is going to sort itself out and everything will be wonderful. In the meantime, the disruption and the valuation dislocation that the last few years have brought has, of course, created opportunities. And it's part of our process to look for those really good companies that have become excessively cheap. And so actually periods like this are positive if you're a long-term investor. And of course, as I say, if you've got a 6-month view, a 12-month view, that's really difficult because I can't tell you where things are going to go over that period. When you've got a 10-year view and a 20-year view, the fact that you can buy some of these wonderful companies at significant discounts just has to be the right thing to do. And so from that perspective, it's very much positive. So it's weirdly, it's quite a nice environment to be an investor, albeit I do appreciate that it requires a lot of patience.
Yeah, definitely. I think a lot of people have had a lot of patience recently. Hopefully we're kind of coming to a better kind of outlook. Matt, thanks for joining me today.
Thank you.
And if you would like to read more about Rights and Issues Investment Trust, you can of course visit the Rights and Issues and Jupiter websites, as well as obviously popping over to the Kepler Trust Intelligence websites as well.